A successful business strategy never involves just one element. Today, we're going to unpack one of the 4 key functions of business. Today, let's unpack accounting. Hey everyone, welcome to the video. My name is Mark Dolfini, but you don't care, and that's okay. In the next few minutes, I'm going to show you all of the basics that you need to know around one specific area. We're going to talk today mostly about a balance sheet. I'll talk about an income statement later on. But for those of you who are beyond the basics, I'm going to encourage you to hang on to the end because I am going to show you some advanced techniques that will help you use those numbers on your balance sheet to your best advantage. All right, so let's talk about the 4 core functions of business, right? Now, like any good strategy, we need to know where we're at and where we're going. So if you've watched the show before, you know the 4 core functions are lead generation, sales, operations, and accounting. And yes, all 4 functions are necessary for performing optimally. So I want you to think about this. Think about an elite athlete. He or she has to watch all the aspects of his health and fitness, or he's not going to be able to perform optimally at a high level. If he or she eats garbage right before a big event, they're likely not going to perform as well as if they ate a well-balanced meal. They might have a finely tuned body, but if their big toe is injured, it impacts the whole performance, right? Well, it's the same thing when we're talking about the 4 core functions of business: lead generation, sales, operations, and accounting. All of them are important, and all of them have to be paid attention to. This is why I'm bringing up accounting, because it's usually treated as an afterthought, and most business owners use the approach of, well, I've got more money in my bank account this month than last month, I must be doing okay. As much as I hate to admit it, this is the exact approach that I took, and I have an accounting degree. Needless to say, this was putting my business massively at risk, and I didn't even know it until things started falling apart around me, and I nearly lost everything. So let's get to the basics. There are 2 main financial statements that you need to be aware of: a balance sheet and an income statement. Today, we're going to be focusing mostly on the balance sheet. I'll unpack the income statement in a separate video, otherwise it's just going to be too long for today. A balance sheet is broken up into 3 main parts: your assets, your liabilities, and your equity. Contrast that with the income statement, sometimes called a P&L or a profit and loss statement. All of those things, by the way, mean exactly the same thing. The income statement reflects revenues or sales, expenses, and a net profit or net loss. So the balance sheet and the income statement are different, but they are interrelated. Again, we'll talk more about the income statement later. But let's talk about the balance sheet, which again is the assets, the liabilities, and the equity of your business. On the balance sheet of your business, your assets are what the business owns. Your liabilities are what the business owes, and the equity is the difference between the assets and the liability. So if the assets of the business are worth, say, $1 million altogether, and the business has $300,000 in total liabilities, the equity value of the business is $700,000. Let's dig into the balance sheet a little bit further. When it comes to the assets of the business, these are the things that the business owns, starting from the most liquid to the least liquid. Now, when I say liquid, I'm talking about liquidity, and liquidity means how quickly can you convert that asset into spendable cash. So the most liquid assets are called your current assets, and the least liquid are called long-term assets or fixed assets or simply non-current assets. For you accounting gurus out there, yes, I know that those all can be different things, but I'm trying not to make you guys into accounting gurus. I just want you business owners to understand the basics. So what are some examples of current assets? These are things like cash. Obviously, that because you can convert cash very quickly, right? So if you've got cash in a bank account, that would be considered cash. Accounts receivable, that would be money that the customers owe you, right, for services rendered. Maybe the business owns stocks or bonds. Maybe the business loaned another business or loaned someone money, and you expect that to be paid back within a year. In that case, that would be a note receivable. How about longer term assets or non-current assets? Well, those would be things like vehicles, equipment, or real estate. Now, I want you to keep in mind that things that would be listed on your balance sheet are what's called book value, which basically means that's the amount that you paid for it. It does not mean what the Kelly Blue Book value is if it's a vehicle, or what you think the market value of something is. So if your balance sheet, you got to keep in mind that that might not reflect the true value of your long-term assets. It's weird, I know, but that's the way the accounting world looks at it for assets that are held in your business. So let me pull over and park here for just a second. If, for those of you out there who've ever put together a PFS, or what's called a personal financial statement, basically it's like a balance sheet for you individually. Maybe you've done that for a loan, like a commercial loan, or maybe what's also called a DSCR loan. It's typically understood that the values that you list on your assets section is going to be what you think the market value is and not necessarily what you paid for them. As a commercial loan underwriter, I saw that stuff all the time. So let's get back to the balance sheet. Keep in mind what would show up on your balance sheet for the business are the balances of those accounts at a specific point in time. So at 9 a.m. on a Friday, the balance in the business's checking account might be $50,000, and the balance sheet would reflect it at 9 a.m. If, let's say, you went out and withdrew $20,000 to pay some bills, by 5 p.m. the balance in that account would be different. Okay, so keep in mind the balance sheet reflects the total balances of your assets and liabilities at a very specific point in time. Contrast that with the income statement, which generally covers a period of time, say 1 month, 1 quarter, or 1 year. All right, now we took a look at the assets. Let's take a look at the other part of the balance sheet, or another part. There's 3 parts. So you've got your assets, your liabilities, and your equity. We're going to look at your liabilities right now. The liabilities, as I said earlier, are what you owe, and the balance sheet will reflect the entire balance of what you owe. So let's say you owed $50,000 on an account and you paid $500 on that account. The balance would then be $49,500. Now, obviously, if this is a mortgage loan where you pay interest, this would be accounted for differently. So we'll just, since part of the $500 payment would go to interest, but for now, we're just going to keep it simple. Just like in the asset section, you'd break down the current liabilities and the non-current liabilities. Generally, the line in the sand is a liability that is meant to be temporary in nature, or one that would pay off within 12 months would be considered a current liability. Anything longer would be a non-current liability. Now, this will matter here in a second when we start looking at some more advanced stuff. So if this has all been a review for you up to this point, hang in there, we're nearly done. What would be examples of current or short-term liabilities? Well, things like balances on credit cards, accounts payable. Maybe you owe money to a vendor or to a supplier. Maybe you have a short-term note out there, property taxes, or even income taxes that would be due payable within 1 year. All of those things would be considered current liabilities. What about non-current liabilities? Well, those are things that might be equipment loans, or maybe vehicle loans, or loans on real estate. All of those things would be examples of non-current liabilities. So we covered the assets and the liabilities. The last piece of your company's balance sheet is called equity. If someone was going to write a check for your company, right, an argument could be made that this is what your company is worth if you were to cease operations, pay all of your liabilities, and that would be the amount that's what your company is actually worth. Now, let's face it. Obviously, for most business owners, this would be insane, since the business itself is much more valuable than the sum of its parts. Now we've got our balance sheet, right? Who cares? Well, this is where I'm going to give you 2 little things to pay attention to when it comes to your balance sheet, and we're going to wrap up this video. One of the things I like to track is my cash in relation to my total assets. I am fanatical about growing my cash position. You've heard of health insurance, right? Well, I refer to cash as my wealth insurance. If you've ever read the book Great by Choice by Jim Collins and Morton Hansen, all of the companies that were in there that had massive growth had cash positions that were 3 to 10 times more than their industry counterparts. And this served 2 purposes: to take advantage of good luck events when they happened, and to weather bad luck events when they happened. So I do a very simple calculation on my balance sheet every single month, and I track it. So I could tell you what it was last month and the month before that, and several years ago. I can tell you what all these percentages are, so I can see and track the trends. So the simple calculation is to divide my cash into my total assets, where I get a percentage. So if I have, say, $30 million in total assets and I have $3 million in cash, I would have a cash position of 10%. Is that enough? Too much? Well, maybe that's a conversation for another day, but I will tell you, back in 2008, when I got my teeth kicked in by the market, when everything fell apart, I had nowhere near the kind of cash that I needed. I had about $6.5 million in assets and about $150,000 in total cash, which was about 2% of my total assets. For my cash, now keep in mind, I also am very heavy into real estate, and I like to have about 10% of my total assets held in cash. This is a number I also track, which means I also know what that number again was last month, last quarter, and from 3 years ago. The other metric that I pay attention to is my current assets divided by my current liabilities. This is known as a current ratio. So again, if you were going to, if you're going to look at your current assets, which includes your cash, your accounts receivable, you might have silver, gold, stocks, all of those current assets divided by your current liabilities, which would be your credit card debt. Maybe you've got a short-term note payable, accounts payable, maybe, again, taxes that you might owe. That number I also track. So again, this is my current assets divided by my current liabilities. So if I say, for example, have $1 million in current assets and $250,000 in current liabilities, my current ratio would be 4-to-1. In general, that is really, really healthy in terms of a balance sheet. An unhealthy one might be a current ratio that is less than 1, where you have, say, $1 million in current assets and $1.6 million in current liabilities, which would show a current ratio of 0.625. Remember, these are metrics I use all the time as KPIs, key performance indicators, and I track them all the time so I can see how things are evolving over time. I don't ever want to find myself in the situation I did back in 2008 with no cash and no ability to pay my bills. That's all I have for today. Remember, this is all about staying strategic. If you've got questions, write them in the comments and I'll be sure to address them. Also, be sure to like and subscribe, and I'll see you guys next time.